Go. Thank you. Just another minute. We'll get started. Okay, well, we are at the top of the hour. Should we begin?
Let's go for it, Brian.
All right, let's get started. Hey, thank you all for joining us today for our strategic finance webinar. We'll be talking about accelerating financial close and forecasting processes while boosting agility and decision-making with Oracle Cloud. I'm Brian DeWert from R-Cubed Consulting, and leading the discussion today, go to the next slide. We have Jim Williams, CEO and co-founder of R-Cubed, as well as Anand Rajendran, Senior Principal Consultant from Doyensys Consulting. Okay, here's what we have planned for today. Let's look at the agenda. We'll start with a quick discussion about why agility matters. We'll talk a little bit about what EPM is and its key capabilities. Then we'll get into some real-world examples. We'll have some case studies that should be very interesting. That will lead to some typical business impact and what you would expect for an initiative like this. We'll wrap it up with how to get started, and then we'll be taking any remaining questions. I see a few more have joined. Welcome. Thank you for joining the webinar. We're just getting started, and I do want to remind everyone that we want to hear your questions. We want your feedback. Please use the chat function at the bottom of the menu, and we'll get to as many questions as we can. With that, thank you again, and Jim, I'll turn it over to you.
Sure, thanks, Brian. So yeah, like we have a pretty packed agenda, so we're going to get right into it. Again, I'm Jim Williams, CEO of R-Cubed Consulting. Anand, why don't you do a quick welcome and hello to everybody?
Yeah, hello everyone. This is Anand here. Welcome to the presentation.
Yeah, and then real quick, before we get into why agility matters, if you saw the slide of our backgrounds, I think our accumulated years of experience is something like 54 years in the Oracle ecosystem. So we're very excited to talk to you today, and we really appreciate you taking some time to spend with us today to talk about accelerating financial close and forecasting with Oracle Cloud. So why agility matters is our first agenda item. We're going to get into that. And we tend to think that agility matters because of the expanding role of the CFO. And that's one of the things we want to talk about. So based on an article in Harvard Business Review in December last year, that first line there, the role of the CFO has evolved beyond traditional financial management. I don't think that's anything that you don't already know. So we're kind of at risk of telling you what you already know. I think the most important thing, though, that I took away from this article as it relates to agility in finance is translating insights into what HBR is calling stories. We think of them as scenarios, potential scenarios and scenario management that impact the company's strategic priorities and capital and operational allocation decisions. That is what we think is the expanding role of the CFO, being able to compel the organization based on scenario management into the right decisions for strategic priorities and allocation of resources. That is the expanding role. And we think Oracle's EPM happens to be one of the most effective ways to build scenarios into your forecasting and budgeting process. And we'll get to that more towards the end of the presentation. With that, I want to turn it over to Anand to talk about what we see are some of the top challenges in EPM, in whatever form of enterprise performance management or forecasting, budgeting that you're doing today. What are the challenges that we see? Take it away, Anand.
Okay, thank you, Jim. So we would like to take a poll here. So please take a moment to indicate the top 3 challenges that you currently face in your organization. Leveraging our experience working across numerous client engagements, we have identified the top 7 prevailing challenges in the industry. So I would like to discuss a little bit about those challenges before we open the floor for a small polling. So let's talk about the first one. It's about the manual processing. So here we are relying very heavily on the human related tasks to manage and execute the business critical operations. So some of the best example would be spreadsheet uploads or the manual approval. So they might seem very harmful at the first, but they can grow and become very bottleneck, quickly become bottleneck if they are not completed on time. So the impact is, as you know, that it can create reduce data accuracy, slow decision making, and in sometimes it can create more traceability and auditing issues as well. And as the business grows, this process just don't stay inefficient, but this also will become much harder to scale up. The next one is fragmented data. Critical business data that are coming across different platforms can cause data inconsistencies. It can cause reconciliation issues and also lacks the real-time visibility. So in other words, we try to end up spending more time in putting the pieces together rather than working together on the insights. So the next one is too many drivers. On this is related to the forecasting. So if we have too many drivers, which can improve the accuracy of the forecasting model, but at the same time, it can add more complexity to it. So this complexity can slow down the entire process and make it more harder to explain to the stakeholders. So in the end, what was meant to bring precision into the forecasting can sometimes create confusion and more chaos. So next one is the lack of visibility. As you know, that when we can see the full picture, it is very difficult to make the right decisions, right? Whether it is a financial data or the operational performance data or the process data. So this lack of transparency leads to slower reactions, missed opportunities, and in sometimes it can be much costlier as well. The truth is, and if you can't measure it, you really cannot manage it. So that's the truth behind it. So the next one is inflexible tools. So in today's fast-paced environment, we need business to scale up to the changes of the environment immediately. So an inflexible tool hinders this ability to adapt to the new changes to the environment and also leads in missed opportunities, inefficiencies, and it makes the innovation much harder. So altogether, this can cause a reduction in the stakeholder confidence in the organization. So this can really hold us back. And when we talk about this, this is like forcing the business to fit the tool rather than having the tool fit the business scenario. So the next one is more resource incentive reconciliations. So here there are more manual interventions required to complete the reconciliations, which would have been utilized for other critical activities. Not only does this slows the entire close process, but it can also create a lot of errors and oftentimes, causes the missed the reporting deadlines as well. And the last one mentioned is the invisible overspending. This happens, when you have the cost that exceeds the budget and you fail to notice it on time. So during this time, what happens is by the time you make visible of those particular errors, it would have been often late to take a corrective actions, and the result is changed cash flow or inaccurate forecast and missed opportunities to reallocate your resource efficiently. So overall, these challenges are not unique to one specific company. They are spread across different industries. But the key here is to identify those challenges early, addressing them systematically, and also so that we can actually move from the reactive approach to the proactive approach. So with this being said, I would request a poll to be open, and I request everyone to um,
Yeah, so
hit the
this is
poll.
our audience participation moment. So I think we've all experienced, and you can tell from Anand, he's lived through these. I think we all have lived through these different challenges. So we're hoping to get a vote from the audience on what are each of your top 3 challenges. I think Brian has the polling open. It's
Yes,
going right now. Okay, we'll give it a
we're getting results.
little bit of Jeopardy time, and then we'll compile the results. And this is also very useful for us because if we can see our audience's top 3 challenges, it helps us highlight how to overcome or how those challenges are solved for with Oracle's EPM cloud. So polls are coming in right now. The rankings right now, manual processes looks like it's number 1. Invisible overspending is number 2. And it looks like lack
We
of
have
visibility is number 3. But let's give it a couple more minutes to make sure we get everybody's vote. All right, I think that's enough time. We have a tie for, all right, so manual process still number 1. Invisible overspending is still number 2. And then we have a tie between lack of visibility and resource intent. And maybe I'm reading to you guys what you can all see. But a tie with number 3 of lack of visibility and resource intensive. And I think those are so interrelated that kind of makes sense. If you have a lack of visibility, a lot of times the way you make up for it is resources and manual heroics. So with that, Brian, do you end the poll or do I do that? I can't remember.
It should be ended.
Excellent. All right. Thank you for that. That helps us tailor our message to around what you guys are saying are your top challenges. So next agenda item is we just want to talk about, from our perspective, what is enterprise performance management? And when we answer the question for any client about what is Oracle EPM or what is Oracle ERP, we tend to look at any organization's enterprise applications from a master data management, an ERP, and an EPM perspective. And the key message of what the EPM suite is, it's an ERP agnostic suite of applications for financial insight, action, and results. Insights, I think we've all heard about that. But I think from some of the best practices that we've implemented and that Oracle has built their software around, and we'll talk more about AI and how that its role in EPM as well. Very highly focused on action and results. Back to that role of the CFO and the scenario management, the driver assortment management, toggling scenarios in and out based on your micro or macro economic impacts, understanding how that communicates throughout the organization to make those types of decisions. That's the action and results that we think you can drive with a transformation or with the optimization of your EPM environment with Oracle's cloud. But the suite of applications, you just go left to right, budget planning, forecasting, and various different types of forecast capabilities embedded in that module, financial consolidation and close for all your entities. And so you have a specific platform for close across your entities and consolidation across your entities. Account reconciliation with transaction matching. We'll get more about that when we're talking about AI as well. Think of AI actually learning your transactions and your matching processes for you as you're going through that process. Scenario modeling, key to agility in finance. And again, managing those scenarios and the driver assortments that go with those scenarios is critical importance to drive the correct scenarios to accomplish some of the benefit realization and the improvement to your organization's financial results. And of course, internal and external reporting. Those are critical as well, and you can use the platform for a significant level of both playbooks and just standard reporting. And lastly, I want to focus on enterprise data management. So this is a part of the EPM suite that allows you to manage hierarchies both for EPM and for ERP. So what that means is you're consolidating your reporting hierarchies, some of your approval hierarchies, some of your personnel hierarchies from a task planning and management, all within the EPM suite. And it gives you a little bit of flexibility between what you might have for financial and operational reporting out of the general ledger and out of your ERP applications versus how you want to manage roll-ups, hierarchies. If you're on a channel retail, maybe you have roll-ups for top 10 stores and bottom 10 stores. If you're wholesale distribution, maybe you have roll-ups by geo. You can look at all of that and build that within EDM, and that significantly improves your ability to manage those hierarchies and again, use those hierarchies against different scenarios. So again, just to summarize, from our perspective, ERP agnostic suite of applications for financial insight, action, and results. It doesn't have to be an Oracle ERP for you to be successful with EPM. I tend to think you have a leg up if you're using Oracle ERP because it's got world-class subledger close capabilities and subledger accounting rules that you can take full advantage of as you're posting from subledgers to GL. But it doesn't have to be Oracle. You can accomplish all of the EPM forecasting, closing consolidation. You can accomplish all of that with Oracle solution regardless of which ERP you're on.
So Jim, there was a question related to that, and I think you addressed most of it, but what integration challenges have you seen when Oracle Financials is not the ERP used with Oracle EPM?
I don't want to sound trite or deaf to the question, but we don't see a lot of integration issues, primarily because we've done so much ETL work. We know what to anticipate. And that transformation is where we might see the most issues. And what I mean by that is if your chart of accounts is not structured exactly the way you want it, then maybe we're doing some transformations of some of those accounts as it's flowing through EDM into EPM. But the challenge is typically around the quality of the data, not the ability to extract it and translate it. In some cases, the ERP may not have the subledger accounting capabilities. And so some of those rule sets might be all being done in the general ledger. And we, to some degree, have to replicate that into EPM. But we've done this so many times, it's not usually the long pole in the tent. That ETL from any ERP into EPM, that's table stakes. We know how to do it. We know how to get it done in a way that unifies the data, much to Anand's point of fragmented data. So short answer is not a huge impact. The long pole in the tent is some of the challenges we talked about. So ensuring that we implement in a way that overcomes manual work, ensuring that we implement in a way that can, conservation or better utilization of drivers and minimizing drivers, making sure that scenario management is in place. Those tend to be much more important to the project than the extract. So kind of a long answer.
But a
All
good
right,
one.
let's keep going. We're going to go through what we consider some of the key capabilities by each of those modules that we just listed for the EPM part of the stack. And the reason we go through them in a sequence is we'll talk a little bit more when we get back to kind of the business impact that we expect. So let's talk about automating reconciliations. So some of the key capabilities in this module: auto matching of transactions, pre-built rules and templates, audit-ready trails, and transparency. Number 4 is actually permeates the entire platform as part of the solution, which is enabled closed task management. You're tracking tasks, you're tracking who's assigned those, and your closed procedures and compliance tracking is also part of that. So not only are you taking transactions and you're automating the matching of those transactions, and you're automating the reconciliation based on pre-built rules and templates, you're actually managing that in the context of an overall close plan. And the reason, again, why we're doing these in a sequence is we'll talk about it when we get to the business impact. We want to be sensitive to your business cycles. And some of this is based on a resource buyback. If you're in the middle of your annual planning process, that's probably not the time to implement a new planning tool. However, you could do some of these reconciliations, consolidate and close really roughly any time within your business cycle. And how would that impact your organization to have a 20 to 30% reduction in labor to automate pre and post reconciliations, have rule-based consolidation for all entities, manage your close assignments, tasks, and collaboration, and communicate status real time and address delays? So you're improving your risk position, strengthening your balance sheet with your pre and post reconciliations being done as part of closed with a 20 to 30% reduction in labor. You're improving audit compliance, and you're creating more time for your resources to do analysis versus data aggregation, moving from the mechanics of close to the analysis of close. And again, that's the resource buyback and why we're going through these in a sequence. Implement productivity enhancements by phase so that you have additional capacity to focus on the real meat of the agility that we're talking about, which is the driver-based scenario management. And these aren't atypical results, and that's why we have a range of kind of 20 to 30%. It can be different with each customer, but we want to pose that question to you so you're thinking about what would it mean to me if I can automate some of these tactical tasks that are part of my close every period, every quarter, every year, and buy back some of those resources to focus on higher level work. Same thing with the integrated consolidation and close. So we talked about fragmented data. Well, the EPM platform is all unified data. It's centralized. It's got automated workflows. Again, number two, workflow enabled close task management. You can see the screenshot there. You have your resources assigned. They're assigned to tasks. You're tracking those tasks. You can show what percentage complete you are real time. That's the closed task tracking and statusing. Utilizing EDM for your hierarchy management, both for who's assigned what and what type of reporting hierarchies are involved. Real-time validations and alerts, intercompany eliminations, reconciliations, all of this are the key capabilities that, again, this is another productivity resource buyback. Again, another 20 to 30% reduction in labor to reduce your close cycle time from 10 plus days to 3 days. So think about that for a minute. Accelerating your close cycle time, but doing it with 20 to 30% reduction in labor to accomplish, on top of 20 to 30% reduction in labor for account reconciliations, both pre and post close. Again, rules-based consolidation for all your entities. So however many entities you have, from 1 to unlimited, it's a rules-based engine for that consolidation, that close process. So again, reducing your time to actionable results and creating more time for analysis versus data aggregation. Again, this one is not as disruptive to your business cycles. This is one where you can begin to implement roughly any time relative to your annual operating plan or your annual budgeting process. And we think that's an important distinction. Another key capability when it comes to dynamic forecasting and scenario planning. So you can see there's different scenarios here. Forecast as a growth rate, forecast in US dollar, forecast as free form, both actuals and forward all the way out to 2026, I believe. These are driver-based periodic and rolling forecasts that they've built scenarios around that they're now managing as part of that scenario management, that storytelling, reacting to either macro or microeconomic or circumstantial situations for each customer. You know, if you look at our current economic environment, it's somewhat unstable. Everybody's talking about tariffs. Everybody's planning for those. You can have scenarios that you toggle in and out of your forecast based on how tariffs might be impacting you. In some industries, they created a rush of demand prior to becoming effective. In other industries, they had a chilling effect on demand. In all industries, they're usually impacting costs. And being able to take driver assortments for those scenarios, so not necessarily all your drivers, but the drivers that are important for that scenario, use that assortment for scenario A, use a different assortment for scenario B, doing all of that management within a dynamic forecasting and scenario planning process with AI capabilities, machine learning, and ultimately getting to integrated business planning, or IBX, whatever you want to call it. That is one of the key points and one of the key capabilities that we think is, again, gets back to agility and the expanding role of the CFO. And this one is sensitive to your business cycles, probably more so than the transactional or the tactical of reconciliations and consolidate and close. And this one has a little bit greater return. So 40 to 60% improvement in your scenario capacity and management, key driver assortments, and AI-infused forecasting. So the ability to convert those financial insights into those priorities for higher return, creating visibility around invisible expenses or invisible spend, improve your working capital position. What would that be worth to your organization? So gaining those additional insights, scenario management, operational investment optimization, working capital position with a 40 to 60% reduction in labor and a 40 to 60% improvement in those processes. So again, the sequence is tactical resource buyback, use those resources conversion from data aggregation to analytics to focus on building your forecast and scenario planning processes within your organization and address those top 3 challenges. With that, another key capability is internal and external reporting. I'm going to turn that over to Anand to talk through that with you guys.
Thank you, Jim. So reports are very important for any organization. So reports can transform data into insights and insights into actionable items. So without them, decision making is like a guesswork. And in this competitive environment, guesswork is not an option at all. So they are very essential for an organization, not just to operate, but to truly succeed in this competitive world. So we can broadly classify these reports into two. So one is internal and another one is external reports. Both reports are generated from the same source, but actually serves a different purposes altogether. So internal reports are about driving performance and shaping the strategies. So they are basically used within the organization. So the leaders, managers, the teams who needs to act quickly and make informed decisions needs to get the reports on time. So some of the reports includes the cash flow and the balances, which will tell them the liquidity and also the financial health of the organization. Then revenue analysis, reconciliation, and aging reports that talks about the numbers, ensuring our numbers are accurate and the receivables are in control. So that will get to them those details. The next one is consolidation reports, which brings the multiple entity data into a one clear view so that the team can know what's happening and they can make a clear decisions. Forecasting reports, looking ahead to plan for what is coming. So we have briefly explained that how forecast works. And the next one is the visualization reports. This turns numbers into actionable dashboards and charts depending upon the business requirement that actually shows you the trend and the risks about those data. So then we have the external reports. These are again, goes beyond your organization. We actually send out to outside of the organization. They often share the same underlying data that we use for the internal reports, but the format, the validation, and the timelines of running those reports are completely different. So some of the examples of these external reports are the statutory and regulatory compliance reports to meet the legal obligations of the country they are operating in. Then the banking and financial reports, which actually shows you the shows you the data about the loans, credit lines, and the reconciliation between your banks and your statements. Investors and shareholder reports to maintain the confidence and demonstrating the performance of the operations. Supplier and customer report. This is also very important to strengthen the relationship between the customers to make it more reliable and timely information is required here as well. And apart from this, there are ad hoc reports that might be required for some of the companies. Those are external that also can be generated from the application. So in short, the internal reports are something that keeps the engine running, if I can compare that. But while the external reports ensure that we have the license, trust, and credibility to drive and keep the organization forward. So both are powered by the same source systems, but they tailor to very different audiences. So now the question is, how are these reports are generated, right? Is it automated or is it manual? But if you ask me, in most of the organizations, these are more manual in nature, which means that it is very prone to human errors and it can slow down the entire process. But this will be much more complicated when you have more number of data to process and also when the business expands globally. So this is going to be a very difficult task. So how does a 40% reduction, a 20 to 40% reduction in the labor sounds like, right? Is it really achievable? Uh, Absolutely, yes, it is possible with inbuilt features of Oracle EPM. So we have AI assisted in a processing workflows, and we can automatically run the reports controlled by the workflows, which can significantly reduce the manual intervention here. So this can help you to achieve a very good credibility with the stakeholders in a faster access to the accurate data and also a smoother and more efficient business operations. So when we talk about these reports at the end of the day, we are not just talking about producing numbers here, right? So these are real reports needs to be delivered quickly, accurately in a timely way so that, the respective stakeholders can make a decisions very confidently. So this is very important. So now I hand it over back to Jim to talk about the next capabilities.
Yeah, so and just real quick on internal and external reporting, what I've seen, what I like about this is once you have these reports in place, it becomes a very comprehensive and reporting solution. And what we've seen with some organizations that even when they go through an M&A process or an internal reorganization, maybe they're spinning off, a divestiture, spinning off something, maybe they're acquiring something. These reports basically become a playbook, and you can establish and ingest some of that data from either the acquisition or the reorg, and create a whole new set of reports for that new organization. You've already got a playbook in place on how these reports work, how you generate them. It's a unified data model. You add some unification from an acquisition to that data model, and these reports are up and going for that entity. So there's some tremendous benefit just inherent in getting these types of reports automated for your organization. There's also some inherent benefit in where you may be taking your organization and ensuring that these reports, once they're in place, can be rapidly deployed to whatever kind of reorg or whatever kind of M&A or divestiture activity you might be doing. We've seen some people be highly successful in that. So the next key capability that we want to talk about is AI. Everybody's talking about AI. Everybody is in the hype there. We tend to think of ourselves as having gone through several technical, evolutions, and this being a huge one, and it will never be the same once AI is fully integrated and embedded in what we do day in and day out. But we tend to separate the hype from the practical application of new technologies. McKinsey just released an article in March of this year where I captured some of the things that I think is a little indicative of AI and where it is in its current evolution. Only 1% of executives describe it as a mature rollout. Less than 1 in 5 are tracking Gen AI solutions, or at least the KPIs. 21% of respondents say they've organized or have fundamentally redesigned at least some workflows. So to me, the promise is there. The practical application of it is not quite there, and it seemed to resonate that way with McKinsey's article as well. What does that mean from our perspective? Again, if AI is not improving the productivity, the workflows, the processes of your teams, then what exactly is AI doing for you? On the left side here, I've listed some AI capabilities in the EPM suite that you can take advantage of. But I really want to focus more on what your approach would be for AI's role in EPM or in close forecasting, account reconciliations. In most cases, people have multiple solutions in place for EPM. They might have a separate planning application from consolidation and close and from account reconciliation. What that means to me is your AI strategy is now fragmented between those solutions, and you have options. You can work with each software provider of those solutions and implement their AI processes for each of those platforms, each of those applications. Or you can take it on internally and work out an enterprise-wide AI strategy and apply that enterprise-wide strategy that you are staffing, you are responsible for, you are deploying into each of those applications. Now, the significant difference between that and between Oracle is Oracle's AI capabilities are integrated into the applications. You have a subscription that you've licensed, you get a unified monthly release that includes AI enhancements. So in the same releases every month for bug fix enhancements, you also get AI enhancements, AI capabilities. And from our perspective, that's a far more economical adoption. So rather than working with each of your software providers for each component of your EPM, Oracle has a platform with AI embedded throughout the platform. You convert that per application investment or internal enterprise investment into platform adoption of subscribed AI across all of your EPM applications. So EDM and everything else within the EPM platform, Oracle's continually releasing AI enhancements into your subscription model. It's a process of taking up that AI capability and adopting it rather than working with each individual software company or working with your own internal IT to generate AI for universal use across multiple applications. So we think that's a far more economical approach to adopting AI and using AI to continue to improve the productivity, the accuracy, the cycle time of your forecasts.
Jim, we do have a couple questions related to the impact of that technology in the close process. First one, what is the expected number of close cycles post go live before the average customer can get to a 3-day close?
Well, it's not a lot. So the short answer is, if not the first one, buy the second one. Because if you think of what were the objective of moving to a world-class platform like Oracle's EPM, that is one of the key objectives. So the entire project is based around improving that close cycle time and reducing it significantly while enhancing capabilities and freeing up resources. So the entire implementation project is based on that. And so through our methodology of setting that up, testing it, dress rehearsing it, UAT, move it to production, we've already planned for that reduction during the project to make it activate as we cut over and go live. If we didn't hit that 3-day cycle time for whatever reason at the first go live, it's first month's close. It's usually by the second month's close. It's not a lot of time because again, the entire project is geared towards making sure that that happens. If that is a key stated objective of the client, the client's already at 3-day close. We're still going to hit 3-day close, or maybe we accelerate it down to 2 or something. But depending on the client's current situation, it is at least the second period close, if not the first.
Great. Thank you. And one other quick question. Can
Sure.
reports be modified or created by the finance teams, or do they require a reports developer from IT?
I think, Anand, why don't you take
Yeah.
that one since you covered reports?
Yeah, sure. Most of the reports are readily available, provided by Oracle out of the box. But if they need to add some customization, some addition to the columns, which we can actually do it right on the tool itself, they provide a provision to create reports, and it is a standard functionality within Oracle. And we don't need any development activity there. It's very quick and easy, kind of a plug and play, drag and drop functionality to create those reports and deploy.
Perfect. Thank you.
Thank you.
Any other questions, Brian?
No more at this time.
Awesome. All right, Anand, we're going to jump into case studies. So I'll turn it over to you.
Okay, thank you, Jim. So I would like to walk you through a very compelling case study here that actually highlights how AI-driven automation in Oracle helped to transform transform the financial close for a global client. So this particular organization, they are a leader in the storage and information management service, and they operate across multiple regions, and each regions they have multiple sources of data that are coming in. So we are talking about more than 150 plus fragmented data coming in on a regular basis, multiple times a day. So this data needs to get into the ERP applications and process it on time. So you can think about the complexity of this data that's coming in, and before the close, they need to process everything correctly and accurately. After correcting all the errors, it has to go into the accounting. Like any large enterprises, this particular client were also grappling with issues in terms of close, and consistently they hit with the delay in their period close. So these delays were not just operational; they had far-reaching consequences. So what I mean is that their financial reporting timelines were being missed regularly. They have eroding stakeholder confidence. They have operational inefficiencies were taking a huge hit, and perhaps the most important one was the regulatory compliance was risk. So they had multiple issues reported based on the compliance, and they missed that. They had to pay a huge penalty to fix and correct it. So as you can see that the comparison of before and after that highlights, how we were able to resolve that issue. To tackle all the challenges they have faced, we have introduced a suite of AI and automated enabled capabilities that helped them to transform their entire close process. So before we implement that, the organization, they used to close the periods on day plus days. That means, they have literally 10 days to process and close the days. But we were able to achieve that on day 3 itself. So, and as per the SLA timeline, they're supposed to close everything before day plus 3. They were unable to achieve that, but after introducing these capabilities, they were able to achieve it. So we have we have provided them an exceptional handling process for them, which is completely automated. So this exceptional handling will look for any errors and automatically correct it based on workflows. So that way, when I talked about this 150 plus fragmented data, so there are some automation in place that actually monitors everything. Some of the errors were handled automatically, and some were informed by somewhere, kind of an alert. We sent it to the respective stakeholder to take action. So this particular change has completely changed their entire data processing. In the sense, we were changed from the reactive to proactive way. So before the last day of the close, we were able to process everything on time. And with the help of that, we were able to achieve the SLA compliance for the close 100% from the day that we implemented this change for the customer. In addition to that, there was another issue with the reconciliation they were facing, because this also adds to the period close deadline. So mostly before the close, they might need to run this reconciliation. I'm talking about reconciliation between different systems to the ERP application, and also within the ERP applications from the subledgers to the general ledgers. So we are talking about two different reconciliations. So we introduced the different templates to create it. So these templates are driven automatically after they complete all the data loading, and this will be emailed to the respective stakeholders. So before the close starts, they just review those reconciliation reports, and this just start normally approve it, because we don't have any exceptions there. So just need to review and approve it. This makes the entire process much faster. So by a day plus two itself, they are pretty much go to close the period, but they won't close it on day two. They will wait until day three, so that they can continue the next processes. And most importantly, we also enabled the a audit for this particular client, and this audit or data is also made visible to the dashboard. So now we have completely eliminated the dependency here, because a leadership team who wants to know what's the status of the close, they can straight away go to the dashboard. They can view using your mobile phone and see what status we have. We have embedded the issues and the period close data into the dashboard. On top of that, we were able to also inbuilt the issue related the tickets from the service now onto this platform, so that in one dashboard they can see everything, and this actually added more time. So this is one of the case studies that really you can relate to. So based on what we have deployed, this was a more agile, efficient, and compliant close process that we have provided to them. We have helped them to restore confidence among the stakeholders and accelerated their financial close reporting as well. So this case study is a perfect example, as I would say, that leveraging the Oracle modern capabilities combined with a clear roadmap, we were able to develop this solution for them, which helped them to give them a measurable results and high compliance and high volume financial environment. They were able to run it very smoothly. So let's move
All
to the
right.
next case study. Yes.
Yeah, here we go.
Yeah. So this case study, we wanted to discuss about this huge retail chain client. They have operations in more than 250 store locations. Like the previous client, they were also having issues with their period close, but the actual issue, underlying issue here is something different than the previous use case. So here the finance team were majorly stuck with a cycle of repetitive uh, reporting activities, and they were always trying to catch up with the month-end processes, and they were also lacking the complete insights of what's happening in the other area. I mean, there are different store locations, so there are collaborative effort required here, so that the one store completes their activity, so that they can give information to the next store to begin and complete their activities as well. There are collaborations required which were completely missing here. So here also we were able to achieve a drastic change in the period close time. So you can see that they used to close on day 15, where we were able to completely change that and revert it to 6 days. So we were able to achieve this with a better visibility and control being provided to them. So we have added more dashboards with more workflow related activities there, so that if one of the store completed the activities, which can automatically trigger the next activity and alert the next person to initiate the next activity. So we have completely removed the dependency from one person to another. And we also introduced a combined dashboard here, so that they can see what is happening in all the areas, which helped them to achieve a better forecasting accuracy. So we are talking about 28% improvement in the forecast. So this all helped them to achieve this huge feat of success. In addition to that, the billing data, the whatever the data, the that are scattered across different organizations, different locations are also brought in timely with automation in place. So this, the help of integration workflow, we were able to achieve this huge fleet of success here. So for this particular client, it was not about building, not about implementing the solution for them. It was a major cultural shift for them. So the finance team moved from a very reactive posture and into a more proactive and insight-driven function, which is empowered by the automation capability that are built in within EPM that helped them to achieve this huge feat of success. So this both case studies can really tell you, how Oracle EPM can bring automation capabilities to a large scale corporation and helped them to achieve this close process on time. Yeah.
Excellent. Thanks, Anand.
Oh,
Brian,
thank you.
any questions come up on this?
Not at this point in time.
Excellent. All right, let's get to our next agenda item, which is business impact. What is the typical business impact we see when we accomplish an EPM modernization or transformation like Anand just described for those two? And you can look at the left side, and again, these are some of the improvements that we see by close, forecast, workflow, adoption of AI. And if you recall going through the slides, we had 20 to 40% improved, reduction in labor to accomplish these things. This typical business case that we're showing here is based on those accomplishments. And then it's also based on the 30 to 60% improvement in financial performance or in forecast performance with relation to top line and expenses within any organization. And one of the things I want to make clear about this is a modernization example. It's based on our experience, but it's also based on the actual, quantified data that we accomplish through those reduction in resource. So 20 to 40% reduction in resources is part of this, but also the improvement in your ability to use driver assortments by scenario to drive better decisions around translating those scenarios into strategic priorities and capital allocation decisions. So back to that Harvard Business Review, we see that also improve your top line and your bottom line management. And that typically grows very quickly. And this is less than 12 months to benefit realization. And what does that mean? From a phased approach, you're going to get some benefit realization from some of those resource buybacks, looking at some of the tactical capabilities, again, depending on how you want to start, where you're at in your annual operating planning process. If you have enough lead time, that might be where you start. If you don't have enough lead time into that annual process, then we might start with some of these tactical resource buybacks. You can do it either way. It just depends on what the prioritization in the cycle that you're in. But each one of those 20 to 40% resource reductions is part of the cumulative benefits, increased forecast accuracy, increased scenario management, leveraging AI into all of that is where you see some of the cumulative benefits as well. The cumulative costs are primarily based on implementation and support of the solution once it's in place. But you can see it's less than 12 months to benefit realization, maybe not 100% of your benefit realization, but maybe the first two phases of benefit realization are within 12 months. That's pretty significant. That's something that is, I think all customers, all prospects should be thinking about how to accomplish that type of benefit realization. At the same time, some of the improvements that you heard about through those case studies. So it's a pretty significant approach to improving your financial performance, improving your close process, but doing so in a way that is highly economical, or at least is within a 12-month window for benefit realization. And in my mind, again, it all comes back to the Harvard Business Review. The CFO has a responsibility, especially in rapidly changing or destabilizing environments and economics, to be able to pull scenarios together and pull those together in a way that communicates to the organization how they're going to accomplish their goals and which scenarios they're going to ride, which scenarios are they going to consider, which scenarios can they swap in depending on what happens with macro and microeconomic impacts. And then I'm going to turn it over back to Brian we've talked about a lot of great stuff with respect to Oracle's platform. What's the next step? How do you get started?
All right, let's talk about how to get started. So if we go to the next slide, as indicated by Gartner's diagram on the left, Oracle has the leading EPM platform. That's great. That's a great place to start. But Doyensys and R-Cubed bring the expertise needed to fully realize the potential of that technology. And so to do that, we are offering a fixed scope, fixed price engagement based on proven and predictable processes that result in a comprehensive EPM transformational plan. And you can see some of the details in the bullet points on the right, the various activities, the workshops, et cetera, that we do that guide you through this process. So you have that transformation plan. So if you're interested in this, you can let us know now or you can let us know later. We'd be happy to follow up, have a more detailed discussion about this. Meanwhile, we would like to open it up and see if there are any remaining questions. So please let us know. And Jim, we did get one before I'd like to come back to.
Okay.
And that question is, how many functional and technical resources are needed to maintain the EPM application?
Well, the quick answer is it's going to be less than you think. And what I mean by that is it's a unified data model platform. You don't have to have skill sets of module by module. Your skill sets can be a little bit more homogeneous with respect to Oracle's platform. It's not a heavy transaction processing system like ERP. Yes, it's imperative or important to your organization from a financial leadership perspective, but it doesn't have the same level of support requirements for an engine that's pumping transactions through it that enable you to, bill and collect and build and make things. So it's less than you think it's going to be. Typically, we see a functional administrator and a technical support person across the platform. It depends, though, on the complexity of your organization, of course. There's some organizations are going to be simpler than others. The complexity of your organization typically impacts the complexity of your implementation. The more complex, the more support. But even in those complex environments, it's going to be less than you think it might be, primarily because it's cloud, because we implement best practices, and those best practices dictate that you stay vanilla as possible, so that you can take up the adoption every month in your monthly release of both applications enhancements and AI enhancements. So our implementation methodology is focused on positioning you at go live with the greatest ability to take up adoption. That mandates staying best practice focused. That mandates having all of the business process change embedded in your go live, in your project. And therefore, you're not going to need a tremendous amount of support. So short answer, it's going to be less probably than you think it should be.
Great, thank you. We do not have any more questions at this time. We will close the questioning here in just a minute. And I believe that's it. So thank you all again for your participation as we continue our series on these topics. And again, if you have any questions or request some follow-up information, please let us know. Otherwise, thank you and good luck.
Yeah, thank you, everybody. Appreciate your time.
Thanks, Jeroen. Thanks for your time.
Okay, I think we can end the recording.